I opened my tax bill, and I swear my heart just stopped. The number staring back at me was almost $10,000 higher than it ever needed to be. And the sickest part? I thought I'd done everything right. I formed an LLC. I was an official business owner. I thought that shiny LLC was my financial shield, protecting every dollar I earned as a freelancer. I couldn't have been more wrong. That single piece of paper from the IRS was proof that I had just made the biggest and by far the most expensive tax mistake that new freelancers make. And today, I'm going to show you exactly what it is so you can avoid this nightmare from day one. When you first go freelance, what's the first thing everyone screams at you? Form an LLC, right? You're told it's this ironclad shield that separates your business from your personal life. If a client sues you, they can't come for your house or your car. And look, that part is absolutely true, and it's a vital protection. So, I did it. But here's what nobody tells you. Here's the secret trap. That legal protection has absolutely nothing to do with how the IRS sees you. In the eyes of the law, my personal stuff was safe. Great. But in the eyes of the tax man, literally nothing had changed. By default, a single-person LLC is what the IRS calls a disregarded entity. It's a fancy way of saying they just ignore it. They look right through your LLC like it's a ghost and see you, the individual, and they tax you exactly like a sole proprietor, which is the very thing I was trying to level up from. That misunderstanding is the tiny seed that grows into a $10,000 mistake. So, for that whole first year, I was operating with this totally false sense of security. I shipped my logs off to my accountant expecting a manageable tax bill. When the final return hit my inbox, I just stared. The amount I owed was thousands higher than I could possibly imagine. I called my accountant, and that's when he calmly explained the line item that blew up my entire year: self-employment tax. He showed me how every single dollar of my profit was getting hammered with a massive 15.3% tax before we even touched my regular income tax. All that work, all that profit I was so damn proud of, was just getting skimmed right off the top. This right here is the heart of the problem. Believing that a default LLC is a tax plan. It's not. It's a legal plan. Think about it like this. If you have a normal W-2 job, you see Social Security and Medicare taxes on your pay stub, right? That's 7.65%. But what you probably don't realize is your employer is also paying another 7.65% on your behalf. But when you're self-employed, you are both the employee and the employer. You get hit with the full 15.3% all by yourself. And with a default LLC, the IRS says all of your net profit is your salary. If your business made $100,000 in profit, you are paying 15.3% on the entire $100,000. After my accountant talked me off the ledge, he told me there was a better way: an S Corp. An S Corp is not a different type of company you form with your state. It is a tax election you file with the IRS. You file one simple form, Form 2553, and it changes the entire game. Here's the secret. An S Corp election lets you split your income into two buckets: a reasonable salary and shareholder distributions. You pay yourself a salary for the actual work you do. And yes, it's subject to the 15.3% tax. But, and this is the magic, any profit left over after that salary can be paid to you as a distribution. And shareholder distributions are not subject to self-employment tax. That is how you stop the bleeding. Let's put real numbers on this. Imagine your freelance business makes $120,000 in net profit. Under a default LLC, the IRS sees that whole $120,000 as your salary. You owe 15.3% on the entire amount. That's an $18,360 self-employment tax bill. Now let's say you are taxed as an S Corp. You determine a reasonable salary is $60,000. You pay the 15.3% tax on only that $60,000, which is $9,180. The other $60,000 of profit is a shareholder distribution, completely free from that 15.3% tax. Your tax bill just dropped from $18,260 to $9,280. That is a savings of almost $10,000 in 1 year. Now, this strategy is incredibly powerful, but it's not for every single freelancer. The catch with an S Corp is the extra admin costs, like running payroll and filing a corporate tax return. Because of those costs, the S Corp election usually only starts to make sense once your business is consistently netting a profit of around $50,000 to $75,000 or more. The other critical piece is that reasonable salary. You can't just pay yourself a salary of $1 and take the rest tax-free. The IRS requires your salary to be comparable to what someone else would get paid for the same job. This is why you absolutely must work with a tax pro to document your salary and keep you safe from IRS trouble. So, how do you actually do it? First, form an LLC with your state. Second, file IRS Form 25553. The most important part is the timing. To get the S Corp status for the entire tax year, you have to file that form within the first 3 months and 15 days of the year. For most of us, that's March 15th. Don't try to DIY this. Talk to a qualified tax professional who gets freelancers. The LLC is an amazing legal tool, but it is not a tax plan. Don't learn this lesson the hard way. Be proactive, understand your options, and take back control of your financial future. If you found this helpful, make sure to subscribe to the channel for more no-nonsense tax strategies.